You know, Carol and I have been focusing on food inflation today. We remember back to one of your themes, which is feed the world, or
a few years ago, actually.
Is it still something that you're focused on? Because for a while you were hot on the farm stocks with an F, not a PH, right. Monsanto and potash and the like. Mosaic, I remember that you liked before it had a huge run up. Are you back into it now?
We still like the farm area, but they have gone, and we just think that the crop problem that you talked about is going to continue for a long time. But the real issue now is that you have an energy policy here at the U.S. which is not correct. Natural gas is selling 50% of what oil is. We have it here in the United States. It's clean. It provides jobs. We should have some stimulus to use more natural gas. And I think, as our analyst Sal Alacqua has said, who has 15 oil and natural gas stock recommendations, this is where the next big area is going to be in terms of acquisitions, natural gas.
Natural gas specifically.
Absolutely.
All right, we'll talk more about that and more with Steve in just a moment.
All right, let's bring in Michael Palmer, volatility trader at Group 1 Trading. He's at the Chicago Board Options Exchange. And, Mike, let me ask you about the momentum trade, because a lot of guys I know that we've been talking to in Chicago are trading momentum here, but we see that there are fundamental issues that can change things, or are there? Do you think this is a momentum issue?
You know, I don't think the market's responding to any one risk factor right now. There's a general complacency to any number that comes out, whether it be employment, inflation, Middle East problems. And right now, the momentum is the way. And until we see, you know, a combination of risk factors, you know, converge, we're not going to have a huge problem in the marketplace.
You know, Steve, you've been a cautious bull. Are you still, that's where you're at here?
Yes, I think the market issue is going to be up. But right now, we're going through a kind of a silent correction. If you look at it, the bond market has corrected already. The emerging markets have corrected already. And the mid and the small cap stocks, which did very well last year, have corrected. The big cap names, the IBMs, the Disneys, they're the ones leading the market right now. So you're starting to see a little bit of correction. We think this may continue for a couple more weeks, but stocks are still the best game in town because the Fed is paying you nothing on cash, and treasuries I hate, so stocks are the only game in town.
Fed Chief Ben Bernanke playing defense on Capitol Hill. We talked about it a little bit earlier over the threat of inflation in emerging markets. Listen to his response.
The bulk of the increase in commodity prices is a global phenomenon. In the United States, inflation made here in the U.S. is very, very low. Now, of course, that's a serious problem, but monetary policy can't do anything about, for example, bad weather in Russia or increases in demand for oil in Brazil and China. What we can do is try and get stable prices and growth here in the United States.
What are your thoughts about? You're rolling your eyes over there.
Well, no, I think he's done a great job in bringing us out of the economic problems we have. But when you keep the printing press going so long, which I don't think we should do. I think they should stand ready in case of a problem. But I didn't think the QE2 was a great program, and I surely don't think QE3 is a great program.
And you've talked about the day of reckoning coming.
Well, we have to pay. I mean, you're printing everything, and it's leading to some of the inflation. He's correct where a lot of the weather is causing a problem, but we also had low inventory stocks on farm products before, so it's something you should have expected. But I just think that the economy, as we've talked for the last 6 months, is fine. It's doing well, and I think that we have to start to ease off the printing press.
What's your take on the inflation scenario? Because there's some infighting going on in the Fed. A lot of people say it doesn't matter that we see food prices and fuel prices going up. We don't see broader inflation.
Well, they wanted to get some asset inflation because we were, as of a year ago or a year and a half ago.
They want home price inflation.
Well, that's a separate issue. But we wanted some asset inflation, but not what I think we're getting right now, because I think we've gone overboard here, particularly in food and some of the other areas. So I think the original concept was great. We had to stop the economy from a free fall, and now I think we're going overboard on the other side. So I think raising interest rates would be the proper thing to do. It was interesting the other day, China raised their rate to 3%, their one-year paper. They're doing a great job over there doing it. We're at 50 basis points. We had a dinner the other night with Hank Greenberg, chairman of CV Star, and he was talking about what China's doing and how they're raising rates. They're on the right track. We have to start thinking about what we want to do, but we have to raise rates and keep the inflation in check. Otherwise, we keep the printing press going for forever.
Steve, when we see, though, we've been talking a lot today about higher food prices around the world and kind of how demand and supply are kind of, you know, smashing together here. Do you anticipate that food prices continue to grow
Well, since
for the future.
Well, I do. I mean, it depends upon these stocks. The problem is we're not going to know about the inventories on food stocks. It's not like every quarter. You don't know until June or July of next year, and then you have the next thing in the fall. So we're a year away from any good news, maybe 2 years away from any good news. You just don't go out as you do with IBM and sell a computer
not so quickly.
and get it done so quickly, or Cisco. This takes a while.
Hey, just 20 seconds here. You say stocks are the only game in town, but Bernanke, if he does what you want him to, will hurt that scenario. What kind of pullback do you see?
Not necessarily. I mean, I think you have to get rates up. It's going to slow the economy a little bit, but the economy is doing very well right now.
But you expect a pullback right now?
Well, I think we're seeing an ongoing correction. I mean, your mid cap and your small cap are flat in the year. Emerging markets are down. Some of the other markets are also down, and the bonds have corrected. So stocks, they're playing you to play, and there's some very good earnings reports out there, and we think that's going to continue.
All right. Hey, Steve, thanks so much for joining us. Steve Kroll from Monness Crespi Hardt.